So we're going to continue on today, before Gemma goes to Europe, to talk about investing a little bit more. Gemma, given you did just re-listen to what we spoke about last week, to refresh your memory, do you want to give us an overview of what we did talk about? If anyone has missed that, they can always go back and revisit it.
Yeah, so both last week and this week's are both going to be about investing basics. But last week we did cover so much ground. So if you haven't watched it, I would definitely recommend that you do. We covered off goals, timeframes, a little bit on risk, but we did lots of education around the market and market cycles. And Lexi had some great graphs on investment returns and the volatility and why it's important to have a long time frame. And one of our favorite sayings is, if in doubt, zoom out. So if you're nervous about what's happening in the share market, if you look at a longer period, the graphs really put it into context for you. So we talked a lot about that. We did touch on different kind of shares, and we had an explanation on like what are the all odds and what's the ASX 200 and things like that. So we covered a lot of the basics. This week we'll be going through a bit more like high level, but a bit more of the detail in it, like your dividends and your yields and how you make money in those, where it was a little bit more general of the basic stuff that you probably might already know but need to know in a bit more detail. This one will be probably a little bit more into what a lot of people don't know about the investing side when they're just getting started.
Yeah. So we'll start then with what we call income and growth. So this applies to all investments. A lot of people know the property version. So for property, your income is your rent and your growth is in the hopeful growth of the value of the property. So with shares, it's very similar. They're just different names and happens a bit differently. So for shares, you can get income, which is dividends. And so that is typically a regular. It might be yearly, half yearly payment of dividends, in which case you get like a cash injection, a bit like rent. And then there is the growth side of shares, where the share price can go up and down. If you're invested for the long term, we're hoping for up. Anything to add to that before we move on, Gemma?
No, not really.
So far, so good. With things like investing your money in a high interest bank account, you do get income, interest, but you don't actually get growth in an investment like that. So that's something to keep in mind. There's pros and cons to that, of course. Like, yes, you don't get the upside of, the bank balance just going up without you adding to it or without interest being added, but you also then have some level of, I guess, security that your balance won't go down. Yes, inflation can play a part in meaning that your money's not worth as much anymore, but the actual balance, if you've got $50 in a bank account, you've got $50 in a bank account. Unless you take money out or there's a fee or something like that, it stays at that $50. In relation to dividends, you might hear the term dividend yield. So we can refer back to the property example to explain what a dividend yield is. With property, you would look at how much rent you're getting divided by what the property is worth, and that will give you a percentage. We can then translate that to having money in a bank account. So the equivalent of a dividend yield is how much interest you're getting. So if you're getting 5% interest, that is like saying you're getting a dividend yield of 5%. It's just slightly different terminology for different types of investments.
Anything to add? Yeah, on that point, so we see, and we commented on this last week, we see a lot of people, we hear a lot of people, especially Australians, talk about how comfortable they are with property and the rental return and the yield, the property yield for how much rent they get versus the property price. But people don't realize that shares do the exact same thing, but you don't have all of the same outgoings that you do with the property. So it's really important to kind of compare those because as Lexi and I were saying before, if there's an expense on a property that you're renting out, that's going to come out of your rental income. You have to get it fixed. If it's a share portfolio, you're not going to get a call from, say, you hold CBA shares and they will say, hey, we need to put a new branch in. Can you cough up some cash? So you don't have those same expenses. So it tends to be that when you have a share yield, like an investment yield that's in equities and things, really you don't have a lot of expenses, if not any, going out of that. Whereas property, yes, you've got your rent versus your property price, your yield, but you might have lots and lots of expenses that have to come out of that at the end of the day.
That ties in as well. I'm glad you brought up banks, because I remember many, many, many years ago when this was actually explained to me, this is the way that it was explained. So we can put our money in the bank, in a bank account, and we can get interest. I'm just having a quick look at one of our major banks, what, if I jump on their website, what interest we might be getting. So in this particular example, what am I going to look at? An online savings. So let's just call the rate 5%. So we're getting 5% interest on our money. If we were to instead invest our money in the bank and buy the bank shares, we wouldn't be getting an interest figure, we would be getting a dividend. And in which case, this same bank, their current dividend yield is about 4.5%. So they're similar. Let's just say they're the same. Let's say the dividend yield is 5% and the interest that you get in the bank is also 5%. So you're getting the same income from both options, but the differences lie in the growth and the risk. So as I said earlier, if you put your money in the bank, there's no potential upside for that money, that $50, as I said earlier, to grow in value apart from the interest. With the shares, there is the potential for the share price to grow. So you have an opportunity then to grow your investment. The downside of that is the downside, where the share price could also go down. So both of those scenarios, investing in the bank and putting your money in the bank, are appropriate in two different circumstances. But I find it a little bit easier to understand shares and investment basics if you can wrap your head around these types of concepts and comparison. Anything to add to that, or any questions from anyone who is currently listening? Let us know in the chat.
Yeah, I think that's really important, is to have something that you can compare it to that makes it less scary, because you need, like when we compare it against scenarios that are really familiar to us, they're not that different at all. It's just a different concept. It's a different way of looking at things. Yeah. But yeah, I think it's really, really easy for people to feel comfortable with putting money in the bank because they can see it and they can see it going up. But over the long term, it just doesn't have that same growth potential. So it depends on what the goal is for that money. And if it's short-term money, then absolutely it's great to be in a bank, in a savings account. But if it's long-term money that you want, a good yield might not be better than the interest rate, but it might have that growth potential and all of those other benefits that go with it.
Yeah. And many years ago, you could have even said, if you're comfortable enough putting your money in the bank, you should be comfortable enough to invest in the bank. That is a little bit different now that we have the government guarantee. So the bank goes under up to $250,000.
What are your thoughts on that?
Oh, what do you mean? What are my thoughts?
Well, I kind of think that guarantee, and maybe I haven't looked into it enough, but I think, is it worth the paper that it's written on? Does it say how quickly you'll get your money back? Does it have any, if a bank has gone under, Australia is in a lot of trouble, right? I just can't imagine the government the next day or the next week going, right, here's your check for $250 to all these people. I just don't know if that security would help me sleep at night. It kind of means nothing to me, but I know a lot of people that's what they hang all their comfort on, knowing that guarantee is there. But how quickly will you get your money back? How often will it be paid? Will it be in installments? How quickly? I don't know.
I have looked into it a fair bit, and the way that I look at it is, yes, who knows what the future holds, but the information that we do have is that there is this guarantee, and this is how it works, that if you have, let's just say, for whatever reason, you have $500,000 in the bank. I don't know why, even if you're not 100% confident with the guarantee, why you would not structure your accounts in a way where you would benefit from that in terms of the guarantee. And what I mean by that is
absolutely to put money with different banks. Yeah, if it's there, absolutely utilize it. But I see people go, oh well, I would invest in, I would have my money in cash over shares because there's a government guarantee, or there's this or there's that, and I'm like, I don't know. Yeah. I just go, yes, if it's there and I had cash out and that I was going to have in term deposits of banks, I'd move them around regardless. It's there, use it. But I don't hold a lot of hope on it actually, I think there'll be bigger problems in the world.
Yeah.
You know what I mean?
No one knows, like no one anticipated COVID, did they? Well, there are some people out there that maybe did, but it's not something that I ever expected would happen and everything that followed. So in terms of dividends, there is more to know about dividends. We're just going to touch on these concepts that you might hear spoken about if you're listening to podcasts or reading about investing. And another term you will hear a lot is dividend reinvestment plans, or DRPs for short. There are pros and cons to this, but before we get into that, we'll talk about, well, what does this actually mean? So you get a choice whether you want your your dividend in cash. And also, full disclosure, not all shares actually pay a dividend, but this is applicable for those that do. So you can have that in cash, whereby your bank account gets credited for your, I don't know, whatever the figure is, depends on how much you're invested. It's a dividend per share that you have. Or you can elect to have that, what we call reinvested. So it will buy more shares in that same company. So let's just say your dividends were, I don't know, $40, and the share price was also $40. You could get one more share in that company instead of getting that $40 paid into your bank account. So the pros of dividend reinvestment plan, and it's going to be relevant for some people and not others, but these are the pros: that it can accelerate the growth of your investment because you're adding to it over time. It's automated, so that I would suggest is a pro in some instances. And there's also a potential cost saving there, because when you're doing the dividend reinvestment plan, you're not having to pay brokerage. So brokerage is the amount that you pay as the fee to be able to, like the transaction fee, if you like. But that doesn't apply with dividend reinvestment plans. The cons, I would say, are that you then don't have that $40 in your bank account to buy lunch or to go on a holiday. Like, these are just random examples, but you don't have that cash to do anything with because you have reinvested it. And there is instances that I've seen where people have done the dividend reinvestment plan, which is a taxable thing. Like, you get taxed on dividends, and then they don't necessarily have the cash in their bank account to pay the extra tax that they owe to cover that. So anything to add to that side of things in terms of dividend reinvestment plans, Gemma?
Yeah, I think, again, it comes back to your goals. Do you have a share portfolio to create income that you're going to live off? Or are you building your portfolio and then, it automatically reinvesting and saving on the transaction fees could be a good thing. Having one in place does add a bit more of a complicated accounting issues as well, and record keeping, because more shares are being bought regularly. So it can cause some accounting issues. I've heard accountants hate them, but if it's part of your portfolio and your plan, your goals to build, it can be great. But Lexi mentioned before that not all shares actually offer dividends, and not all dividend shares actually have dividend reinvestment plans. So it might not actually be an option. You might not be able to actually reinvest. They might automatically pay your dividend out. But if that's something that you think could work for you, you can look at the shares that you hold if they actually offer that.
Yeah. The other things that we were going to talk about today was around liquidity. So that's another term, like dividend reinvestment plan, like dividend yield, all those other terms that we're talking about today. So liquidity is how liquid your investment is. Can you get the money back out that day? So if you think about a property, well, number one, if I had a property worth $1 million, can I have that $1 million tomorrow to buy a tropical island? No, I can't, because these things take time. There's settlement, that kind of thing. It is liquid, but it's not yet. With something like money in the bank, I can get it out same day. With, say, a managed fund, it might take a few days. The thing that we were talking about earlier today as well, Gemma, is that you can't sell a bedroom. So did we talk about this last week? I can't recall.
No, I don't think we did. But yeah, that's exactly right. Like, if you had a lot of equity in your home, you can't just tap into that and buy and get money out to use it for something else. Whereas you could sell down a portion of your share portfolio or take a portion of your money out of the bank. Yes, there's ways you could do it. You could, get a joint owner, or you could get a loan for this. Like, there's complicated ways you could do it. But when we talk about liquidity, it's like kind of at the drop of the hat. Can you reasonably, within a couple of days, if the worst happened, access some of the equity that you've got in these investments? And like Lexi says, you can't sell a bedroom generally.
And so that particular comment, maybe we've talked about it in one of our like super/retirement type episodes, whereby if someone is approaching retirement and they have all of their life savings in property and they want a new car, or they want to go on a big expensive Europe trip or something, they may be forced to sell their entire property because maybe they can't get a loan in retirement, in order to access that money to go overseas. And there are other things like reverse mortgages. We're not going to go into that. I'm just, I guess, going over the broad concept. Whereas if they had $1 million in shares instead of $1 million of property, they can say, okay, Europe is going to cost $50,000. So let's sell $50,000 and be left with $950,000 of our shares. So as we're kind of getting to here, we're talking about investment basics, but we're highlighting that there is no one right option. It's about assessing your situation and assessing your options, finding out what you're most comfortable with, which ties in with risk tolerance. Maybe we can touch on that now, Gemma.
Yeah, and that comes back to diversification as well, because people think, diversification's about the asset class, like not having all your money in one share because it's risky, but it's also having like different layers of actual assets, like having some money in cash, like your emergency fund, or to fund a few years worth of holidays or whatever that is. And then your more long-term assets, and maybe then you've got property as your portfolio, but you know that if you need short-term money or medium-term money, you've got these other assets that you can go to. So people tend to, I feel like the people that I've come across in financial planning, they gravitate to one type of asset class, like shares or like property, or they're happy with their super or cash. But really, you need a mix of all of these things to have a really robust financial strategy and foundation that you can, at the time, depending on what the expense or what the need is, you can decide which asset is it going to be more appropriate for you to use. And if you've diversified, maybe it's not a good time to sell your property, or maybe it's not a good time to dip into your shares. So you use cash instead. And then when it's a better time to sell your shares, you might top your cash back up. But yeah, having different asset classes that do different things and different structures is really important.
And you just touched on exactly what I was going to highlight there as well, in terms of, and this is getting a little bit more technical than the rest of this session, but around asset classes. So you can diversify. You can, let's say, keep it basic. You can have shares and you can have property, but then within shares, you can have Australian shares and you can have international shares and lots of other things. But the way that I look at diversification is a little bit more like accessing the pros to, when I say pros, I mean pros and cons, accessing the pros of lots of different types of to reduce the impact of the cons as well. So as we typically say, not putting all your eggs in one basket. With risk tolerance as well, this is like the sleep at night factor. So what would you say about risk tolerance, actually? Let's start with that.
Well, I would say it's got to pass the sleep at night test. But yeah, so with risk, so you can do, questionnaires and all this kind of stuff that says, your risk tolerance is medium or balanced or growth or whatever it is. And it says how much volatility you're willing to withstand, what your time frame, it takes into account all of that kind of stuff. But I think the particular asset, so whether it's superannuation or it's a share portfolio in your name or a property, that group can be quite risky if you look at it in isolation, but you always need to look at all of your assets. So if you have a cash, take that into account, like what percentage is that compared to the shares, and that's going to reduce your overall risk. But in the same vein, people don't consider that they might be taking a lot of risk with their share portfolio and their super, and then they own one house that they live in that's in one street, in one suburb, in one state. So overall, that's a really risky strategy because you're very aggressive in property, shares. So yeah, I think rather than just focusing on the diversifying in just the thing that you're focused on, whether it's your share portfolio or your property, you need to look at all of your assets together, what level of risk they hold. Would you
Yeah.
agree?
Yeah. And I guess you can break that down even further, that there are what we call speculative shares and there are blue chip shares, and they, I guess, come with their own risk level. I was talking to a client yesterday. She was just explaining what they had been talking about as a couple, and he really wants to invest in a brand new company that will be listed shortly. And it is what one would regard as a speculative investment, and it does come with higher risk and potential for high upside. But she was already, like, I didn't even have to contribute to this. She was just sharing their thoughts and saying, well, how much are we prepared to lose and walk away with? And they acknowledged that that was more of a gamble as opposed to their other regular investing that they're wanting to do.
And that is the instance where people refer to investing as gambling. And we say that investing is not gambling, but when it is something like that, you know, you're kind of betting on the next big thing, and there's not a track record, a proven history, a balance sheet of that company, you know, regular income that you can see in that company, all of those kind of things. It is like gambling, but you could have a small portion of your portfolio in it, you know, in things that you're really passionate about or you're excited about or you think will be good. But yeah, make sure you diversify on things that have a solid foundation on them as well, that are more likely to just be stable and secure for your portfolio.
I would even argue that it would depend on the level of analysis that's been done as well. So it might be that you're at the barbecue and Uncle John says, oh, did you hear about blah, blah? Like, you should definitely invest money. Like, you should put $5,000 in it. That is different from maybe an investment analysis, for example, looking at something and making a really calculated decision that based on what we know about this business, we're prepared to invest in it, not just that it was a hot tip.
This is actually a conversation that I've had with my ex-husband like for ages. So at different points in our relationship as we were building like wealth, there's been opportunities like where he's heard of a like the next hot thing or whatever, and it'll usually be like a penny stock, right? Like it's 1 or 2 cents or whatever, and then it's doubled or tripled or whatever, and he's like, we should have bought that share, I told you we should have bought that share. And I'm like, yes, but also the amount of money we were prepared to invest in it, like the disposable income that we had at the time, yes, it doubled or tripled, but it might have been dollars to us.
Yeah.
You know, and in hindsight, you know, yes, you were right. It did do well, but we could have also lost, say, $500, which was a lot of money to us then. So it's all in perspective and hindsight as well. But a lot of the time, I think you need to know what your strategy is and why you're doing something. You can get distracted with all of these things that you should have, could have, would have done. But if you have, you know, your core satellite type of strategy that, you know, well, this is where our focus is, and maybe we do have a little fun with something that we're excited about, but what's our actual plan? Otherwise, there's just stuff popping up all the time that you get distracted so easily from your actual goal and focus.
Yeah. And you just touched on another, I guess, investment basic that anyone listening can go away and have a better read of to understand. And that is this core and satellite approach. So, you know, your core holding might be the investments that have the track record, and then within the satellite you can have those other things that, you know, you're just interested in and you want to play around with, if you like. So that is, I think, the end of part 2 of investment basics. Let us know in the chat if you do have any questions before we go, but otherwise we'll be back in the new year. It was just after Australia Day, wasn't it?
I can't remember the date, but we'll get it posted on the platform and on our socials as well. So, yeah. So Lexi's always really good at posting updates and stuff on her Instagram, which is moneyvine.com. And mine is gemmamitchell.finance. Benito will also keep you updated with things that are coming back. But we've got all of the past recordings are on the Finito platform, so you can look back at them at any time. You can search in the search bar if there's a topic, and it'll come up with either our stuff or other creators on there. So go and check that out.
Also love to hear feedback too. So for those that have joined us live today, if you can let us know if there was anything particular from today that you learned, that you really liked, if you had an aha moment, any feedback is welcome. Okay, well, I will see you. Well, I'll see you soon, but I'll also see you in February.
Okay, yeah, I'll see you before then. Okay, bye.
Bye.